Welcome to the Shifting Investor YouTube channel, where I'll show you a better way to invest for retirement while reducing risk. Alright, hello everybody. Welcome to my new channel called the Shifting Investor. The financial road is always changing. Keep shifting. So, a little bit about me. I am a product manager, former engineer, Excel junkie who has developed a system of investing mainly catered towards retirement investing that I think is a better way to take advantage of variation in the market while constantly reducing risk as you get older. And the intent of this channel is to teach you about my methods and show you the spreadsheet system that I use and the formulas you need to take advantage of the system, which I think does a very good job of beating the markets when it is not doing well and performing very closely but with a lot less downside risk when the market is doing well. So I have a lot of good useful information to share. I'm not one of those guys that's gonna put some fake books behind me to make me look more impressive. Um, I think I'm a pretty sharp guy. I have a bachelor's in engineering degree from the Rochester Institute of Technology. I used to work in automotive engineering. Then I earned my MBA at the University of Michigan, and that's where I became more dangerous with Excel. And I've been a product manager for about 20 years. That's the part of marketing nobody knows about, but it really involves understanding your company, your whole business, and working with engineering and marketing to launch products that customers want. And it's very, very helpful to have the business education, the analytical background from engineering, to understand what goes on in the markets. The main advantage of my system is that it doesn't matter what BS investors or analysts are pitching your way, what tweets are coming out of the White House. Nobody really knows what's going to happen. The only thing we know for sure, based on history, is that there will be variation. Any fund or market or commodity will go up or down, a few percent here or there. And in the long run, equities tend to go up. So taking advantage of this variation can make you a lot of money while reducing risk, and that's the intent of the system. If you follow it and use the formulas without letting your psychology take over, or without letting the news take over, you can do really well in the markets, as I found from using it for the last 20 plus years. The system does take some effort, but it's a lot more lucrative than a side hustle where you make $20 in an hour. With this system, you make a trade in 10 seconds and you can make $20 just like that. One thing to remember is that I'm not a financial analyst or financial planner. The content of this video is not direct advice for anybody in particular. It's a system that's worked for me. I think it has a lot of principles and a basis that can really help a lot of people out. You can use any of these strategies, all of them, or none of them. If nothing else, they'll make you think. So the fundamentals of the system are all based on the premise that every sector of mutual fund or ETF goes up or down eventually. In the near term, they go up or down a little bit every day. In the long term, investments tend to go up just because the nature of currency and inflation and long-term trends. That's all we really know for sure. And it doesn't matter why they do it, they just do. That's what's nice about this system. The whys, the back BS calculations of price to earnings and all that, none of that matters because you can't count on the meaning of any of that. In fact, right now, we're in the midst of a pandemic and high unemployment and a shrinking economy, and yet the market is going up. So there's no rhyme or reason, and even when there is, you don't know what to do with that. So the one thing you do know what to do with are the actual numbers and the variation when you use this system. And some funds do give dividends, and that can only help you get more returns on your investments. So that's another thing to consider. So you're probably wondering, what is this guy talking about? I'll show you in detail in future videos, step by step, the types of formulas and calculations you need to do to trade on the fly and make the right moves. If you're a new investor, how do you get started in the system? Basically, unless you're paying down high interest debt, you want to put as much money as you can in your 401k or your IRA, whatever the case might be. Regardless, make sure you get at least the maximum 401k match from your company, because that is free money. I know it varies from company to company, but if they match up to, say, the first 6% of your income, a certain percentage that they throw in for each percent, make sure you put in at least 6% each paycheck. That's essential, because who wants to give up free money, right? And if you have to find a way, save somewhere else, cut back on the lattes, cut back on the beer, whatever it takes. The key to my system that has worked for me so far, and like any expert will tell you, is to put in money as early as you can. Time always works in your favor when it comes to investing. The younger you are when you put in your money, the better. I started investing in my mid-20s, and I think that's been a huge asset to the growth. One thing you never know is, or can't control, is when you're born. So you could start working in the midst of a recession, and actually that's a good thing, because you start putting money in when everything's cheap. You make more money in the long term. You might start working when the economy is booming, which means the prices tend to be higher, and there's a lot of things that you can't control that this system will help you kind of smooth over, and to help counter those effects. So every 401k has some investments to choose from. Some offer a wide variety. That tends to be true in larger companies. Some offer 6 or 7. And one of the keys to the shifting investor system is to make sure you have, at least in the beginning, 5 different types of funds. And what I recommend is a large cap fund. So those are companies with large market capitalizations. And they're usually ones located in the U.S. if you're in the U.S., working in the U.S. A small cap fund, so those tend to be smaller companies, a little bit more volatile, a little bit more room for growth historically. And then an international fund or an emerging markets fund. So international tends to cover the whole globe, some developing as well as developed countries in Europe and Asia. And then emerging markets funds, which tend to be ones from markets that are still emerging. So whether they be in South America or Asia, they're a little bit more volatile and risky, but there are other advantages that I'll talk about later as to why you might want to invest in emerging markets funds. And then you also want a bond fund. We'll talk about that later. That's like owning debt that you're loaning money to companies versus owning part of the companies. And then the other type of fund you want is a money market or an income fund. That's basically like your piggy bank, your cash fund that you want to sell profits into and buy funds from as things change day to day. One thing you don't want to do is do not invest in a target retirement fund. I'll explain specifically why in a future episode. I've read some bad things about them, and some people have gotten burned by them. You want to be your own retirement fund, let's put it that way. Who else do you trust but yourself? I don't trust anybody. I trust the math and randomness and long-term trends. That's it. If you have a few IRAs or 401ks from old jobs or whatever, Try to resist the urge to get rid of all the other ones. Maybe if you have 4 or 5, you might want to consolidate into 2, but at least keep 2, and I'll explain why later. Um, but as you're setting up your newest 401k or your current 401k or IRA, what you want to do is put 40% of your money each paycheck into the income or money market fund, and 15% split up in the other 4. So it's 40% plus 4 times 15% adds up to 100%. And I'll get into detail a little bit later on why you want to do that. It kind of seems counterintuitive, but basically you want to put money in something that's not volatile to take advantage of volatility and buy into other funds when they're down. Going back to my earlier point about keeping things in a few brokerages, one of the other reasons I didn't mention is that if one of them has an outage, which can happen, at least the other one is available to trade with, and that can save your butt, especially when there's a lot of buying and selling going on a certain day when market tanks or just skyrockets. There's a lot of traffic, and things can go south with respect to the apps or the websites. So it's good to have a backup, to have a second brokerage. Chances are that both won't go down at the same time, and that is a good thing. And then with respect to the funds you pick, once you go further along in this investing system, you'll want to expand into other types of funds beyond these 5. And I'll explain about that later in a future episode. The key is you have to do something what I call over diversify. Going back to my earlier point about not knowing what the hell is going to happen, right? If you don't know what's going to happen, why wouldn't you be in everything? And then you're covered no matter what happens. I mean, nobody foresaw this pandemic, for instance. These black swan events can happen, and they change everything in ways that nobody can foresee. If you're over diversified, you're always covered. And one of the key elements to running the shifting investor system is to create a spreadsheet that incorporates the formulas and keeps track of how your funds are doing, how much money you've made off of each one or lost. And the formulas tell you what to do, what to trade when. So that's another important element of the system. I am working on a template that I can make available. I might charge a nominal fee for that. But I have a spreadsheet that I've been running since 1997. And the template has grown and the system has grown and changed, but the formulas behind it are not super complicated, but it's the secret sauce that makes this system work. And to me, it's valuable, and it's been working for me for a long time. So from what I've told you so far, you may have a lot of question marks as to what this all really is. I want to explain what this system is not. It is not just another day trading system. I'm not some sleazy sales-ish kind of guy that's going to promise you'll make millions of dollars if you give me $10,000. It's not that. It's a slow, methodical process that increases your earnings while reducing your risk as you get older, and that's really important. I mean, I've seen a lot of people in each financial crash that have lost a lot of money right before they retire because they were either too greedy, thinking things will always go up, which they never do, or they just didn't understand the risk, or they were ill-advised by financial planners who aren't really looking out for them. So I want to prevent that from happening, and this is really what I call a week trading system, not a day trading system. So you're going to make quite a few trades during the course of a week, probably in the beginning, maybe 1 or 2 in a day. And by the time you have a lot more money and a lot more funds, you may make 6 to 8 to 10 trades in a day. But now it's so easy. And now that brokerages are allowing trades for free, it totally changes the game. It makes my system that much more effective because you don't have the losses associated with trading. And I think the big difference between this and what day traders do is that you're not I'm not advocating trading individual stocks. I'm advocating trading mutual funds and ETFs because they spread out the risk more for a given sector. So, like energy mutual funds or real estate investment trust funds or bond funds or stock funds, those are assortments of different companies, bonds, or stocks or whatever within one fund. So you're spreading out the risks amongst different companies. You don't have to even study any companies. You just kind of go with the flow, understanding that maybe some funds are better than others, but in general, it's more about the sector they're in, meaning what type of fund is it, as opposed to which specific fund it is. There is some judgment involved. It's not a system where you don't use your mind at all, because how you divide up your money takes some judgment and some guessing, But then nobody knows better than some random predictions, right? We've seen investors who've thrown darts at a dartboard and outperformed investment analysts who are usually wrong anyway. So who cares what they think, right? Um, the key here is taking advantage of variation and trends, long-term trends. Variation is your friend, volatility is your friend, and I'll explain why in a future episode. Another thing I'm going to do for you in the course of these videos is dispel a lot of financial myths, I call them, or investing techniques that when you step back and think about the math behind them, they don't make sense. They're very arbitrary. They're just regurgitated over and over in all these financial investment advice articles, and you really have to question the motivation of why people are telling you what they're telling you. Either it's just easier to explain, or they want to make more money off of you. Um, I'm not going to make money off of the trades you make, so whatever I tell you is going to be based on what I think is the best system, not what is best for me. And I think that's important for you to understand. So I'll be dispelling a lot of myths. The big one that I always think is just full of BS is rebalancing quarterly or on any periodic basis. And then the other one that I'll explain, which doesn't make sense, is dollar cost averaging when you buy periodically, like every paycheck. So stay tuned. I hope you are interested in what I've talked about so far. I'll have a lot more details and charts and graphs and spreadsheets as I figure this YouTube stuff out. But I'm excited to share my investment journey and learnings, and let's make money in a better, safer way, regardless of what the economy does, regardless of what analysts say, and regardless of what anybody tells you to do. So that's it for my first episode of The Shifting Investor. Look for more episodes every week or two going forward. We'll see how this pans out. Thank you very much. Okay.